Hello and welcome back to the Dukascopy TV studio. I'm Natalie MacDonald, and joining me now for the second part of their Impact Investment Corner is Quadia Managing Director Guillaume Taylor. Guillaume, thank you very much for joining us today.
Hello, Natalie.
So impact investing was first pioneered in the 1970s and has been particularly popular in the US, with Europe slightly slower to catch on. Why is that, and are we seeing a change in investors' attitudes in Europe now?
We are seeing a big change in investor attitude in Europe, but it did start, as you mentioned, in the United States. The term impact investing was coined actually in the United States in 2007 by the Rockefeller Foundation, but its activities have existed since the early 70s, late 60s. And it was derived from the social unrest movements of the late 60s. And impact investing has picked up in the United States specifically because it got a big push from the private foundation or philanthropic movement. And big, well-endowed foundations decided that they wanted to implement mission alignment or mission-related investment strategy into their portfolio. And that got a big boost. And as you know now in the States, most of the foundations need to distribute at least 5% of their capital per year in order to be tax exempt. But what's interesting is since 2 or 3 years now, the foundations have been able to implement or distribute that 5% through an impact investing strategy. So the public sector, through the Rockefeller Foundation and setting up the GIN, the Global Impact Investing Network, the US government has set up OPIC, which is the Overseas Private Investment Corporation. All these public initiatives gave a great boost to impact investing. But it is picking up in Europe so far. In Europe, you have to remember we always perceived that the role of creating social and environmental value was the role of the governments. The governments had to fulfill those tasks, and so we didn't think that the private sector was really was in need to focus on social and environmental issues. I would say there's a difference between the US and Europe. The United States has focused a lot on social issues. In the United States, impact investing is more about financing companies that are providing services and products for people at the base of the pyramid. In Europe, it's picked up recently, but it's been picked up by people like myself who have come from the traditional financial sector. And so we're not looking at it from a philanthropic point of view or more ethical, feel-good, wanting to give back to society what we've received point of view. We really feel that it's a logical way of investing. It's a complement to traditional investing, so it's not in contradiction. And so a lot is happening now in Europe, and it's probably going to change whether Europe is going to take the lead.
A report by Monitor Institute estimated that by 2020, impact investing could account for 1% of assets under management globally. Given the current economic crisis and budget cuts taking place globally in the US Medicaid, for example, does this limit or broaden opportunities for investors in this sector?
Again, I think there's a difference between the United States and Europe. In Europe, it will definitely broaden the scope for impact investing. We feel that impact investing is about innovation, and innovation thrives in periods of crisis. And today, as there was such a dependency on governments to solve the issues, and that there's not as much money flowing into the government's pocket, they're trying to entice the private sector to get involved. So the European Commission, through the initiative of Michel Barnier, who's the European Commissioner on internal market and services, has created a group of experts to look at what is needed to allow the proliferation of small and medium-sized social enterprises in Europe that can provide localized, innovative solutions to social and environmental issues. Also, major multinational companies in Europe are creating venture capital departments, venture capital arms, to finance companies that are providing innovation in the supply value chain. And even in certain cases, these venture capital teams are reporting directly to the sustainability boards or teams of the major multinational companies. So there's a big movement in Europe that's happening now, realizing that the public sector can't satisfy all the needs, and that the private sector has to come in, but it has to work in partnership with governments. So the impact investing in Europe is really looking at these innovative models, and it's picking up. In the United States, it may slow down a little bit because, as I mentioned before, the impact movement was linked to the philanthropic movement, which was enormous in the States. And if there's less money flowing into philanthropy, there may be less money available to allocate towards impact investing, as impact investing was really led by the foundations.
Just as with traditional investing, there's still a risk-reward element involved in this sector, both socially and financially. What should investors interested in this sector be looking out for when investigating new projects?
So that's a big challenge that we have in impact investing, is how to integrate the social and environmental aspects into our risk assessment model. We do that very well for the financial risk and returns. We can analyze them, we can quantify them, and we can integrate them in investment decisions. How do we do that with an intangible, these famous externalities, which are the social and environmental issues, and how do we give them value and use them in a model? And that's a challenge that we have. So when investors are looking at these projects, they have to look at the financial, social, and environmental issues, but on an equal level. So they have to have an equal weighting in the investment decision. And that's a challenge. At Quadia, we've developed a ratio that we call the Dalmolin ratio, which is derived from the Sharpe ratio, but we're just adding an impact element to the risk-return model of the Sharpe ratio. And that impact element there are some statistics, but a lot of it is intangible. It's qualitative information, and how do we transform that into numbers to create this ratio, to give value to the investment decision. It's a major challenge, but it's happening. And I think when investors go into impact investing, they have to be able to integrate those social and environmental issues into their thought process, and decide and not just focus on an investment saying it has financial value and the social and environmental issues are aside. They have to be bundled together and looked at it together. So that's when we look at these projects, we have to look at those. That's three-dimensional investing that we call, whereas traditional finance is a two-dimensional investment process.
Guillaume, thank you very much.
Thank you, Natalie.
Quadia will be joining us shortly to continue to give us more insight into impact investing. For now, though, goodbye.